Hi, everyone. Good evening. Thank you for joining in. Welcome to the fifth series of the What You Need to Know webinar series. We are so excited. Thank you for joining us for series 1, 2, 3, and this is the fifth series. We are so happy to have you. This webinar is put together by the Port Harcourt community of This is put together by the Port Harcourt community of YouLead Project. Right off, we are going to be talking today about investments, the investor's mindset. We have an amazing guest speaker today with us, and we are going right ahead to let you know about our guest speaker. Charles Boyitie is a distinguished investment professional skilled in financial analysis, financial modeling, valuation, and value creating investment analysis in the Nigerian business and investment space. He currently serves as a senior investment analyst for an investment holding company in Nigeria, where he supports the team in the execution of value creating initiatives for the company. Charles bagged a first-class honors degrees in banking and finance from the University of Benin and is currently rounding up his studies in the Chartered Banker MBA program at the University of Bangor, United Kingdom. He has demonstrated an unwavering commitment to academic excellence, which has earned him accolades, including the Best Graduating Student Award in his department and faculty, as well as the prestigious Best Banking and Finance Students in Nigeria award by the Chartered Institute of Bankers in Nigeria. Beyond his professional roles, Charles is deeply passionate about the efficient allocation and management of private capital to drive economic growth. He leverages his expertise to provide valuation, financial modeling, and advisory services to startups, assisting them in raising over 500,000 US dollars in seed capital. Charles envisions a new and prosperous Nigeria where his skills and vision contribute to the nation's growth and development. Amazing guest speaker, Mr. Charles. And now we are bringing over Mr. Charles Boyitie. Welcome, Mr. Charles. It's so good to have you here. We can't hear you, Mr. Charles.
Can you hear me?
Yes, we can hear you now.
All
You can
right.
go on.
All right. Thank you very much. I was saying thank you for that introduction. And thank you to our live community for joining. So glad to be here, and I'm honored to be part of what the YouLead project that is going on in Port Harcourt. Thank you very much to the organizers. Okay, so without further ado, we'll be going straight to the presentation. I understand the flow is we have a 30 minutes talk, and then we have a Q&A session where we would have question and answer from the audience. So I'll just
Yes.
jump through to the presentation. So today we're talking about investors' mindset, evaluating investment opportunities. And this topic is interesting to me because I'm sure, as with every other Nigerian, I've had my own fair share of bad investments, right? Making wrong investments and then losing your money. So, and it's very intriguing that in the earlier part of my years, I got to involve myself with poor investment opportunities, and then until that I'm now an investment analyst evaluating investment opportunities. So today, what we would look at, just want to set the tone for what you expect to get by the end of this webinar. So the objectives of this webinar is simple. By the end of this webinar, the attendees should be able to, one, differentiate between good investments from scams. They should be able to understand some key criteria for evaluating different investment opportunities, and then they should be able to understand the principles for building wealth, right? So these are the objectives that we seek to achieve from this webinar. Okay, so our first slide talks about bad investments and your experience. I'm going to show some images, and I'm going to ask a question. How many of us can relate with these images below? So we have some very famous logos here that I'm sure if we should have an open mind, everyone would have a thing or two to say about these investments. And and as you all know, that these investments, they only end in one thing: premium tiers. So it's very interesting because back then my own case was one of that's very fascinating. I'm sure a lot of people, maybe either you did one or you did two or you did three, you made money in some, you lost for at some. For my own case, it seems like every time I join this scheme, that is when they pack up. So it was when I joined MMM, because the day I joined, this was way back in school. It was the month I joined, that was the month that MMM stopped paying. Then somebody told me about, there's this new one, Ultimate Cycle. I was like, okay, I put my money. It was the week I joined, that was the week that Ultimate Cycle packed up. Then I said, I'm not doing again. And one of my friends came and told me, there's this new one. No, this one is really paying. It just paid me. It's called Twin Cars. And then I said, okay, no problem. And like like the ignoramus that I was back then, I put my money in Twin Cars, and that was the same week that Twin Cars packed up. So I've had my fair share of Ponzi's, and that looking back is just a reflection of, wow, a lot of mistakes that we made that I want to turn as a lesson to be able to educate our audience today, that there are better ways that you'll be able to evaluate, to know if an investment opportunity is good or if it's not. You hear things like 30% ROI. I'm sure every Nigerian is famous, is aware of that phrase, 30% ROI. People promising returns that are above the roof. So today we're going to look at principles. We're going to look at thinking patterns on how you can be able to evaluate investment opportunities. When people present opportunities to you, be able to say, no, this is a bad investment, no, this is a good investment, and this is the one that we should go, and this is the one that I should not go into. So before that, we're going to lay the foundation. We're just going to talk briefly about what assets are and what liabilities are before we go into the investor's mindset discussion. Right. So this is just to lay the foundation so that we're able to know, because investment is actually in the context of assets, right? So when you're investing, you're actually investing in an asset, in an idea that's going to generate revenue for you or generate profit for you. So you need to understand at least what an asset is and what liabilities are. Just the background topic. All right. So what are assets? So assets basically are things that you own that provide value to you or economics but benefits to you. So things like land, things like a house, a rental property, anything that you own that is providing you value or economic benefits is known as assets, right? And when you own an asset, what you expect is to earn money from that asset, or at least you expect the value of that asset to increase so that you'll be able to sell at a higher price than you bought. So that's the purpose of why people invest in assets. So you expect the value of the assets to increase, or you expect the assets to give you steady stream of income over time, right? So in summary, the purpose of assets is to put money in your pocket. That's what assets are for, things that you own that puts money in your pocket, right? And in investment space, there are really broadly two categories of assets that you can invest in, right? That's what we call real assets, and that's what we call financial assets. So real assets are things like your land, your buildings. You can invest in gold, silver, precious metals. Some can even invest in commodities, right? You can buy a cow and sell it out and things like that. Those are real assets. They are real because they they have real value. They have real value that they provide. And then on the other hand, there's so-called financial assets. Now, these are things that relates to things like company shares, the stock of a company, the bond, commercial papers, even things like your piggy vest or your carry-wise safe lock is a financial asset. So if you invest your money in your carry-wise lock and they're promising you what 12% per annum, so if you put 100,000, you know by the end of the year you're going to get something more than 100,000. So you're going to get 12% more. So that's a financial asset there. That's the financial asset that you invested in. Mutual fund, all those are assets, financial assets. And another class of asset that you can think about is intangible assets, things like software, patents, but those ones are really investable on their own end. So this is what assets is all about, and it's very important because our discussion about evaluating investment opportunities is really about understanding what the asset looks like. What is the asset? You hear people talk about Bitcoin being a digital asset. So every investment opportunity you see there, you are investing in an asset. So it's good to understand what an asset is. And we're just going to talk briefly about liabilities. Sure, most of us know what liabilities are. So liability essentially are things that you owe, obligations that you owe to other people that you must settle either now or in the future, right? So any expenses, you can look at it this way: any expenses that take away money from your pocket is a liability. So your debt, your interest payments, rent expense, data expenses, giveaways in some cases. Giveaways can be liability sometimes, especially where it now becomes a regular thing, where you do it regularly, so it can become a part of liability that you have to give away. So this is just the foundation for the assets and liabilities, and I'm sure this will set the tone for what we are discussing next. So we're going to go to all right. So before we move on, a good financial goal is to ensure that you increase your assets and reduce your liabilities. And we're going to see this in more details in our last slide. We'll talk about principles of building wealth. What you want to do, since assets are things that put money in your pocket and liabilities and things that take away money from your pocket, you want to be able to increase your assets and then reduce your liabilities. That's what the goal. Is the very basic principle of finance, that you increase your assets and reduce your liabilities. So we're going to go to the meat of the discussion today, and it's about evaluating investment opportunities. How do I know if this opportunity is good for me? I'm seeing a lot of people telling me, oh, this person promises to give me this amount of return for this period of time, and how do I know if this investment is good or if this investment is not worth it, or if it's a scam? So that's what we want to address in this section now. So the first thing you should know is a good investment opportunity is not just one that gives you a very high return. A return is just one part of the investment. Anybody can promise you high return. They can promise you 100% return in a month. Anybody can promise you that. But a good investment opportunity is not just one that gives you a high return. And there are different factors for you to consider in determining whether an investment opportunity is viable or not. Now, I'm going to streamline the context here to you individual investment. So you investing in a particular investment opportunity. So somebody presents something to you and say, let's invest, let's put our money here. Because evaluating investment can be broad. You can be evaluating investment for a big company, can be evaluating investment for a capital project. But I'm going to streamline it. The context here is for, okay, you got a question? Okay. All right, all right, all right. Yeah, yes, there'll be question and answer in the at by the end of the presentation. Thank you. So I'm going to streamline the context here to you evaluating investment opportunities for yourself, individual investment opportunities. And I'm going to talk about three key principles that have, based on my experience and over the time looking at different investment opportunities, that three key principles or thinking hats that I think as an investor or as a prudent investor you should look for before you make any investments. And the first is think value. This is the first principle or first thinking pattern that you should have, is think value. Now, what you want to understand here is, how does this investment generate or provide value, right? And what is value? Value is the benefits that you derive from making that investment, from letting go of your cash. So if I invest my money in this endeavor or this investment opportunity, what is the value that I'm going to get? What is the value, and how does this value come? Right? So value comes in two forms, and this is very, very key. Value comes in two forms. The first is the economic value, right? And then the second is the real value. So the first is economic value, which is economic value here is the cash or the monetary benefit that you get from an investment. So if you buy a rental property, for example, and you rent it out, say you own a shopping complex and you're getting rent from it on a monthly basis or on an annual basis, that rent that you're getting there is the benefit, is an economic value that you are getting from that investment. If you, as in the case of let's use digital asset like cryptocurrencies, if you buy low, then you hold and then you sell high, you've gained what they call capital appreciation. So you've gained increase in value, you've gained gain from that sales. So that economic value is one of the value that you can get. So when you are evaluating an opportunity, investment opportunity, you want to check what is the economic value to me, right? What am I going to get from this investment? There are some investments that can give you steady stream of income, right? And there are some investments that there's no income from it. You only make money when you sell off. And you need to understand the difference between those two, right? Those two forms of economic value. One is called capital appreciation, and the other is called income. So capital appreciation is where you buy something for, say, 100 naira, and after you hold it for a period of time, you sell it for 200. So you make an extra 100 naira. So that gain that you get from buying investments at a lower price and selling at a higher price is called capital appreciation. On the other hand, income is the revenue or profit that you get but from the activities or from the utilization of the asset. So I give a good example about the shopping complex. So if you own a shopping complex, you will be getting rent from that property. That rent there is an income that you are getting from that asset. Another good example is if you buy shares of a company, and let's say the company makes profit and the company pays dividend. That dividend there is income that you are getting from owning shares in that company. So that part is called income. And it's very important that you're able to distinguish these two, because there are some people that want that steady income to be coming, and there are some people that say, look, I don't mind, I'll be able to wait until I sell off the investment. So you want to be able to know what kind of value is this investment bringing me, right? Now, the second, which is real value, which I think most people don't really pay attention to this place, because economic value, you can easily ask, oh, how much am I going to get from this investment, right? But there's something else, a fundamental value that you need to question when you are evaluating an investment opportunity, is what is the real value of that investment, right? What is the real value? And what is this real value we're talking about? The real value here is the problem that the investment opportunity is solving, or the need that it is satisfying. I'll take that again. The real value of an investment is the problem that investment opportunity is solving, or the need that it is satisfying. And it is this real value that drives the economic value of an investment opportunity, right? So I'll give you a good example, right? I'll give you a couple of examples. One of them is, let me use my famous shopping complex example. If you own a shopping complex, what is the real value of that shopping complex? The real value of that shopping complex is that you are providing shelter. You are providing a business space where people can sell their goods or where people can transact. That is the real value of that asset, right? So if you take another example, say if you buy a house, a residential house, or you own a residential property, and you rent that property out, and you're getting rental income from that property, the real value of that investment is the shelter that you are providing to the people that are renting the house. So because there is a real value, because there is a real need that is being satisfied, it means that the value that is coming from that investment is a good one, because it's not just an investment that is coming out of thin air. So if you contrast this, just using this one taking out, if you contrast this to things like Ponzi schemes, where they tell you that, oh look, if you invest in this, let's use MMM for example, they will give you 30% return on investment for the month. Now, where would they get that 30% from? They only get the 30% when somebody else joins the scheme. So meaning there's no real value that they are solving. There's no real value from that investment. So what is going to be the source? How are you going to get that 30%? That 30% is not coming from anything real. It means that it's not sustainable. So that we're going to talk about sustainability next. But you need to understand any investment opportunities that you are presented with. The first thing you want to ask is, okay, what is the economic value, which is what am I getting from this investment? But beyond that, what the next thing you want to ask is, what is the source of that value? What is the real value of this investment? So if you say, let me invest shares in this company. Let's use MTN, for example. Say you want to buy MTN shares. If you buy MTN shares, you can make either you buy at a particular point in time, and then when the price increase, you sell, which means you make capital gain, or you buy and you hold and you receive dividend when MTN pays dividend. But the real value of MTN, which is where is that money, that dividend that are going to pay me, where is it coming from? The real value is coming from the fact that MTN is providing services that satisfy clients' need. So you are going to buy data, you are going to buy airtime. They are providing these connectivity services, they are providing telecommunication services. It is from this real value that they are able to generate the economic value, which is the dividend that they will pay you. If there is no real value driving an investment opportunity, it is most likely that investment opportunity is not viable. So if there's one thing you should take out from this point, is that if there is no real value driving an investment opportunity, it means that investment most likely is not viable, especially in the long term. It's not viable. You can work in the short term, but after some time to crack because it's not satisfying a real need. Even if you want to, somebody say, oh, let's buy a car, let's use a car to do Uber, it's going to give us 30%. We're going to be making good returns from that investment. The reason the Uber or the taxi cab services is going to give you good return is because there's a real value that cab is satisfying. What is that real value? It's providing transportation services to people. So to think like an investor, you want to be able to think in terms of the real value that an investment opportunity is bringing. If an investment does not have any real value that is driving it, it's most likely that the economic value that is coming from it, the returns that they are promising you is thin air. It's not going to last, and most likely it would look like a scam. It's going to be like a scam. So the key point here is understand that you want to think in terms of value. What is the value that is attached to this investment? How am I going to get those value? And then what is the source of those value? How are we getting those value? Because if you don't understand the source, if there's no source driving, if there's no real value driving that investment opportunity, is most likely not viable. So the next point we're going to talk about is think long term or sustainability. Now, this is very, very important. This is very, very important, and it's tied to the first point. So yes, I know that this investment is going to give me 10% per month or something. The next question you want to ask is this return sustainable? Is this return sustainable? Right? Because some people can overpromise, especially in cases where you need high capital to make profit from a particular investment. If you need high capital, some people, because they need your capital, they will promise you a lot of high return. Now, the investment may not necessarily be bad, right? There may be a real value, for example, but because of the kind of return that is promising, you may say, if you look at it over a long period of time, you'll see that, look, this thing is not sustainable. I'll give you a good example. A good example, I'm sure some of us have seen a lot of people in advertising things like invest in forex and will get you 30% per month or something, or 20% per month, right? Now, forex in itself is not a bad is not scam. Forex in itself is not scam. However, you should know that forex, there's no income that comes from forex. The only gain you make from forex, back to our point one, is capital appreciation. If you buy a currency, they're not going to pay you any dividend, they're not going to pay you any interest. You buy a currency low and you sell high, or you buy a currency low and you sell high. That's essentially the business of forex. You trade. It's trading. It's more trade than an investment. However, so because people trade and they need capital to trade, sometimes they can now do, okay, let's collect people's money and let's trade with those money, and then we'll pay them return. Now, that in itself can be a good, if you look at it, okay, they are doing trading services, they are trading the financial market, which may look like a very good thing. But if they promise you return like 30% or 40% per month, what you want to do is you want to look at how sustainable is that return. If you're paying me 30% per month, can you pay me over the next 3 years, over the next 5 years? How sustainable is that return? That's why if you do look at it, any good and experienced forex trader does not guarantee you return. They will not take your money and tell you, I guarantee you, I'll give you 30% per month. No experience. I know a couple of good, correct forex traders. They don't promise you that I'll give you 30%. In fact, what they can promise you is a very low return that they know that they can make. But once the return is exorbitant and you want to think about, look, how sustainable is this investment? So if you think about long term, it will help you know the investment that can last, and the ones that maybe it is by the time that you put your money, that's when it will crash, right? Like the experiences that I had. So think long term, think sustainability. Also, another viewpoint from this thinking long term is there's some investment now that probably in a short period of time, in the short term, they may not give you good return. But when you look at it over the long run, when you look at the services, that the real value that this investment is going to bring, you say that over the next 10 years, this thing is going to be the next big thing. So I'll give you a good example. A good example is if you're in the Lagos area, you know about lands. People are buying lands in remote areas like those those remote lands. So when real estate companies invest in those remote areas, they are not looking at the value now. They are thinking long term. Over time, development is going to come to this area, and that's going to drive the value of the investment. So from that angle too, you can also use that to evaluate an investment opportunity. That, look, okay, this thing is cheap now, but it's because people are not seeing the value now. If you think long term, you see that this thing can become valuable. And there are a lot of businesses that it takes time for them to actually unlock that value. There are a lot of businesses like that. So don't think short term when you're evaluating investment opportunity. If you think short term, two things that you might do. One is you might miss out on an investment opportunity that is cheap now, but it doesn't provide you good value in the short term, but in the long term, it will provide you great value. So you can miss out on good investment opportunity. On the other hand, if you don't think long term, you may invest in a bubble, something that can crash anytime soon because it's providing high return now. You may want to jump on it and say, let me quickly make a buck, let me quickly invest and get out. But by the time you invest, that may be the time that the thing will crash. So think long term. It will help you sieve out investment opportunities that are viable and sustainable from short term scams that will burst anytime soon. And the last last point we're going to have here on evaluating investment opportunity is think exit. Think exit. So what do I mean by think exit? So think exit here means how easy is it for me to exit this investment opportunity at any time? So yes, you told me to invest. Yes, you're going to give me 10% return. If I invest, if I want to pull out my money, can I pull out my money easily? And that's a very, very important question to ask as an investor, or as someone that wants to build wealth, because there are a lot of investment opportunities that you put your money, and by the time you want to take out your money, it now becomes a problem. You hear things like, oh, we don't withdraw it during this period for now, or there's something going on, we need to wait for something to happen before you be able to withdraw. Once there's a lot of difficulty with the exit, you should just pay careful attention to it. So pay careful attention to things that it is not easy for you to exit, because liquidity, which your ability to exit, is very, very important. It's very, very important when you make investments, or you make investment. Even if you're buying a real asset, if you're buying a land, for example, let's use land banking, for example, and you want to buy land in a remote area, assuming that development will come. You also want to think how easy it is for me to exit this investment opportunity. So how easy it is for me to sell. Say I want to sell today, I want to sell tomorrow. Will it be easy for me to sell? And I'll just give you a tip here, that this is why sometimes most people buy land through real estate companies, so land developers. So there are people that buy large expanse of land, and then they divide it, and then they sell it in bits and pieces. The advantage of such buying land through such companies is because it is easy for you. Sometimes you can even sell the land back to them. Say you want to exit, you can't wait. You wait for 2 years. The value has gone up a bit that you think you can enjoy, and you want to exit. You can say, okay, look, I want to sell the land. You can sell the land back to them. So that opportunity to be able to exit the investment is an advantage that people take in buying land through these real estate development companies. So it is very, very important. The point here is, it is very, very important when you're evaluating an investment opportunity to look at the exit. Okay, now I've joined. How easy is it for me to exit? Or you start a business, you want to start a business, you want to invest in this business. Okay, yes, this business is just a startup and I want to invest. When you invest in that business, how easy can I get my money back? Or how easy for me to exit? Especially if you want to invest in the, let's say, short term, 1 to 2 years. After 2 years, will I be able to pull out my funds if I want to pull out my funds? It's very, very important to check the cost implication and everything that surrounds that investment opportunity in terms of exit. So this is the 3 key principles that I wanted to discuss. Think value, which is what is the value of this investment to me, and what is the source of this value. And then the next one is think sustainability, think long term. This value that this investment is promising me, is it sustainable over the long term, over 1 year, 2 years, 3 years, 4 years, 5 years, 10 years, or is it something that is just within 6 months? So we want to think long term. And then next is you want to think exit. How easy can I exit my money? And this last point is very important for investment that you don't earn income from, you only get capital appreciation. So invest things like let's say cryptocurrencies, for example, where if you buy, the only time you will make money from such investment is when you sell. Which is when you exit the investment. So you want to invest in cryptocurrencies, or you want to invest in assets that, okay, if I want to sell, or when I want to sell, it is easy for me to pull out my investment to cash my gains. So those are the 3 thinking hats, investors mindset, that you can apply among many other factors to be able to help you evaluate investment opportunities and sift through scams from viable and good investment opportunity. So next, we are going to look at principles for building sustainable wealth, and this is the last slide before we take our question and answer session. So we're going to look at 3, or essentially 2 principles that have been scientifically proven to build sustainable wealth. You can apply this whether you are just starting out your career, whether you are married, whether you're a family person, whether you're a student. Anyone can employ these 3 tactics to build sustainable wealth, right? So before we go into the discussion, I need to explain what I mean by income expense gap. So the income expense gap is the difference between your income and your expenses. So that's just simply what it means. It's what called income expense gap in finance. So the higher the gap, the higher the better. What does it mean? It means that your income, your monthly income or your annual income is higher than your monthly or annual expenses. So the first principle to adopt in building sustainable wealth is grow the gap. Grow the gap. And what gap are we talking about here? The gap here is the income expense gap that I just explained. So there needs to be a gap between your income and your expense. And by all means, your first goal or one of your primary goal is to be able to grow this gap. This gap should be as wide as possible. Let your income keep growing, and where possible, your expense should be declining, or you should be able to minimize your expense to the barest minimum. This is how you create a gap for you between your income and your expense. Now, how do you create this gap, right? So one way to create the gap is there are two ways, basically two ways. Either you increase your income or you reduce your expense, right? And increasing your income here could be increasing your income earning capacity, right? And I found this to be true, especially if you're just starting out your career, right? If you're starting out your career, you don't have a lot of buffer cash in your bank accounts to go and invest, right? So what you want to do is you want to increase your income earning capacity. And how do you do that? You invest in knowledge, you invest in skill acquisition, you apply for better paying job, you start a side business, whatever it is, right? Because the first time you start out in building wealth, you don't want to go and be investing buying land or buying, in fact, you may not have enough money to even buy the land, or you don't want to be buying stocks or shares of companies. Those will not give you good return because the capital you are bringing to the table is very small. So the best investment you can make when you're starting out to build your wealth is to invest in yourself. Increase your earning capacity, invest in knowledge, invest in your skill. When you invest in your skill, what you are doing is that you are increasing your income earning capacity. That is what will increase your income, is what will create a big gap between your income and your expense. And then as your income is increasing, there's a tendency for you to want to increase your expenses as well. But this is where the cautiousness now come in, that look, as I'm increasing my income, there's also need for me to continuously review and prudently manage my expenses, right? You want to create a budget. Okay, I'm going to spend X amount of money on food. I'm going to spend X amount of money on this and whatnot, right? So you want to budget your expenses so that as your income is growing, your expenses is not growing at the same rate as your income is growing. By the end of the day, if that happens, you find out that you are earning more, but you are spending more. So you need to consciously, this is a conscious effort to review your monthly expenses and continuously find way to increase your earning potential. And then the next thing you want to do when you are continuously increasing the gap is to invest the gap, right? Now there is a gap. You are earning, let's say 500,000 and your monthly expense is, let's say 200,000. So there's a gap of 300,000. What are you going to do with that 300,000 naira gap? You're going to invest that gap, because the only way for you to grow wealth is for you to be earning money, earning income on your savings or on your investment. You need to be able to earn on your sweat. So if you are earning, I don't know, 500K, 1 million, whatever it is you are earning, 300K, the savings, the difference between your income and your expense, that money has to work for you. You have to get your money to work for you while you are not there. And the only way to do this is to invest, not savings. Yeah, you can save to build up cash, but you have to invest. You have to invest that gap. So what can you invest that gap in, right? So there are quality investment opportunities, things like real estate, land banking, stocks, high interest saving account, mutual funds, commodities. There are a lot of investment opportunities. Again, the purpose of this webinar is to help you understand how to evaluate investment opportunities. We're not going to deep dive into the different investment opportunities, but there are a lot of them. And from the last slide that we talked about, you should be able to use the principle that you've learned in the last slide to evaluate those investment opportunities that are available to you. So invest the gap, invest in real estate, invest in mutual funds, commodities, and whatnot, and then you repeat the cycle. This is the cycle. You grow the gap, you invest the gap, and then you repeat, because it's a continuous flow. You continuously find a way to increase your earning potential, continuously review and prudently manage your expenses. Now you've created this gap between your income and expense. You want to invest that gap, and then you want to repeat and repeat and repeat and let the money grow. And that is all I have for you today. that brings us to the end of the session. So we'll be moving over to the Q&A session. Thank you very much.
Thank you so much, Mr. Charles. Like, my notes is full. It's been an amazing section, very insightful. Like every point delivered had a meaning. I think one key thing I took was, if you want to start building wealth, you have to, the first thing, the first investment you have to make is investing in yourself. Because
Yeah.
I mean, that's like a long-term return you can ever, that's like the biggest investment you can give to yourself. Thank you so much. So
Yeah.
before we dive into our Q&A, so I want to, this is like a personal experience, because you gave 3 steps in identifying like good investments you can um invest in. Like you said, think value, think if it's sustainable, think long term, and an
Mm-hmm.
easy exit. So there was
Yeah.
something I invested in, right? And the ROI was 15% for a year,
Okay.
right? That's fair.
Okay.
I Because I was like, okay, it's not extra.
Mm-hmm.
Like 15% for 100,000 naira. That was the amount I invested in. So it was like
Okay.
15,000 for you. I'm like, that's quite reasonable. They had, can you hear me?
Yeah, loud and clear. I can hear you.
Okay. So they had like, the ROI was very low. It was reasonable. They had amazing website. I went to every nook and cranny. But
Yeah.
I think the thing I didn't do was the easy exits. Because probably if I'd listened to this webinar then, because you
Yeah.
just keep your money and then you can only collect it at the end of your 1 year
The
completion. So these
mm.
people had ROI, right? 15%. But then it was like a like an agri farm investment, but it
Mm.
was online.
Mm-hmm.
But they had
Mm-hmm.
a physical site that they showed us, right, on
Mm.
Instagram and
Mm.
everything. You could see the
Uh-huh.
farms, you could see the pigs, and I'm like,
Yeah.
okay, it's a legit business, so to say.
Yeah. Yeah.
Towards the
So there's
end, yeah, towards the end of that year, we're just like, oh, the animals have had some diseases. I was just like,
ah
hey. Like
another
the animals
story.
have had some diseases and all of that, because you could see, oh, clients, they made videos. Clients have come to check like your, like the animals, your investment is safe with us. They were
Yeah.
constantly communicating with us.
Yeah.
Constantly communicating with us. Yes. And so it was just like, okay, these people are legit. They saw their uniforms. I'm trying to remember that name. Is it farm? I can't remember. Is it farm power or something? An
Yeah.
influencer even validated that business. So now I'm
Ah.
saying, how can one, if you take these 3 steps, right? Because
Yeah.
I think they had value, that it seemed like a very good value. You had a farm, you could see the pigs, you could see the goats, you
Mm-hmm.
could see the
Mm-hmm.
animals. The
Mm-hmm.
ROI was really, it was not a greedy ROI that you say, oh, 30%. What were you thinking? It was
Yeah.
15%.
Yeah.
So now I want you to analyze if that ROI, let's start from there, if it was really fair to begin
Mm-hmm.
with, if 50%,
Mm-hmm.
15% was
Per
too
annum. Yeah.
much, or yes,
Okay.
I will need you to answer that. And also, long term, I mean, agric is something we know that will always be there.
Yeah.
Will always be there. We know that losses are bound to happen,
Yeah.
right? But then I think it's sustainable, and that kind of ticks your second point
Mm.
that says think long term or sustainability. And
Mm-hmm.
then the last point, easy exits. I know that
Yeah.
that's the part, judging from your webinar already, because
Yeah.
before you even mentioned easy exit, I'm like, I want to ask this guy what if I had done all these steps and you mentioned easy exit. I knew that was the unique flaw, because
Yeah.
you only see your money there, but you really can't
You really
see
can't. You
the
can't
end
take
of
it
that
out.
year.
Yeah. Yeah.
Yeah, you
Like.
can't take it out to the end of that year. But every other thing, their website, even after the whole thing crashed, they like sent a mail and they're like, oh, we are going to schedule a Zoom call meeting and all
Mm.
of that. We're really professional. And it's hard
Mm-hmm.
for me to fall for this, because I'm like, I went and checked every part, their
It happens.
website,
It happens.
influence.
It happens. Yeah.
And then that happened. And before you know, when we tried to join the Zoom call, they're like, oh, attendance is full or something. My friend was just like, Mimi, this people is like this, so it will never end. Just remove your mind.
Mm-hmm.
So
Uh,
I want to know, first of all, that ROI, for anybody who's thinking, okay, this ROI is saying 5%, right? Is it fair? And this easy exit thing, like
Yeah.
before you just so you answer everything at once. This is the exit. There are some things you said, like the whole capital appreciation thing, or there are some things that you really, if you are thinking long term, you're saying long term investment, you have to
Uh-huh.
keep that stuff for a while to like really
Mm-hmm.
grow if you want to make it. So I need you to kind of this life real life scenario that happened to me,
Yeah.
right?
Okay.
Yeah, so if you will kindly
Uh,
analyze it. We have
sure.
questions already rolling in. Yes, thank
Sure.
you.
Sure. All right. So I understand, and I think for those investment, the return looks fair, right? 15% is fair, right? But usually, especially with things like agriculture, farm produce, and all that, right? What happens is, unless the management, you want to look at the management capacity. What could have happened is probably they overextended themselves. So yes, you're promising 15%, but maybe what they needed was, let's say, for example, let's say they needed 20 million. But by the time they open the investment up, what they are getting things like 100 million, 500 million, right? And 500 million is fair, but 500 million is a huge investment. But for 15%, it's 15% on 500 million. You have to look for what you are going to do with that money. You cannot just buy all birds, right? You're not the so the management can then overextend themselves, and that could probably lead to issues. So those are that is one of the factors that could have affected that investment. I don't think 50% is fair, but one of the things that you want to look at is, look, there are some returns that they look low, right? But if you look at it, if I give this guy 1 billion, can he give me 15%? It can't give me 15%. And I'm not saying 50% is too high, right? No, but and if you look at what they are doing, right? Look at what they are doing. Look at their farm. Look at their stuff. Those investments, you just have to be very careful. You want to look at the management capacity, look at what they've done before, and look a lot of agri things, a lot of things. There's real risk involved, right? And I'm not talked about that here because that is when you're looking at, okay, there are two different good investment opportunities, and you want to look at the one that has low risk and high risk. That's a different conversation. So you want to look at the risk also involved, and I think that's also on an area that you look at when you're evaluating investment. But I
The
think
risks involved.
15% is fair, but you did your best. It happens.
Yeah,
Investors
no, they
happen.
turned out to be risk hammers because they logged us out, like you could not comment, and then we saw another page that they created the same thing. I'm just like, okay. So let me read
Okay.
out a question. It has been displayed on the screen, but with
Okay.
the way the economy is, how do you continue to grow the gap enough to invest? You said something about growing the gap, reducing your
Mm-hmm.
expenses,
Mm-hmm.
right? Increasing. So this person is saying, with the way the economy is now, Nigeria, this webinar is happening right now from Nigeria, right?
Yeah.
After all, there's only so much one can do. So how do you
Mm-hmm.
continue to grow the gap to invest in an economy like Nigeria that's currently in shambles?
Okay. Okay. All right. All right. Thank you very much. So what you want to do, right? I'm not going to, there's no one answer fits all, right? One cap that fits all,
Okay.
right? But what I'll attempt to answer the question in a light that would be practical for you to apply. So what you want to do is you want to play in a market that is big for you, right? So if you're in a career, you want to be in a career that has huge opportunity. And by huge opportunity, what you want to look at is what is the big players in that investment or in that space, in your space. What are they doing? Who are the big players? So if you are in the real estate space, or you're a real estate trader, you look at the top sellers, how much are they earning? The top real estate brokers, how much are they earning? Or if you are an accountant or whatever you are, the first thing you want to do, you want to choose the right field to play in, right? There are good opportunities. You can be a farmer if you want, but you want to look how many farmers are billionaires, right? So you want to look how many, that thing is very, very key. Any space you're playing in, okay, you're in the tech space, how many tech people are billionaires? How many, right? You want to look at that. Okay, once you get that right, which means you are not playing in a space that has opportunity, because believe it or
Yeah.
not, in this Nigeria, people are still making good money from some space, from some things. Good money. I'm making money every day. So you want to be where the money is. You want to be where the money is going, right? So now
Yeah.
that you know that, okay, I'm in the right market or I'm in the right space, the next thing you want to do is to improve yourself to become the best. You want to invest in yourself. You want to get the right knowledge. You want to become indispensable. You want to get all the skills that is needed, skills that are valuable and skills that are rare. Those are the two things: the skills that are valuable and skills that are rare. So for example, you can learn, say I'm a graphic designer. It's good, right? Graphic designing is great, but
Mm.
graphic designing is not rare. It's not a rare skill. You can easily go on Fiverr and get a freelancer to do a graphic design for you. So why that is a good skill by the side, something you can do by the side, unless you want to become really like the 1% graphic designer in the world, it's going to be difficult for you to play. So pick skills that are valuable, pick skills that are rare, pick careers that have high opportunities, and then strive to become the best. Invest in yourself. In the earlier period, it's going to be difficult. I'm going to tell you the truth. In the earlier period, because you're just learning and you have that knowledge, that curve, that learning curve that you're trying to walk through. But once you tick off, there's that tick off where people now say, oh, look, I think this guy has something to offer. And once all you need is just one opportunity to get you at the door. So, and once you do that, you'll be earning good income. Once you get good income, you keep on learning, keep on improving. And another thing that I would say is, if you're trying to, in this economy, please, you have to be bold. And being bold here means go for opportunities that are bigger than you. You have to go for the big opportunities. They are not meant for some class of people. No, you have to believe that every opportunity that is big and that is good is still for you, right? So you want to get into the right space that you know that, okay, there's no something wrong, fundamentally wrong with the career path that I'm doing all my investment. And then you want to increase your learning, increase your value by every knowledge you can get, every skill you can get that. And then you want to go for the big dream. You want to go for the big job. You want to go for that big gig, apply for those companies, and then use that as your leverage. I'm telling you, this is it. I'm in the investment space. There are companies in Nigeria that they are looking for skilled people. There are a lot of job opportunities in the space where I am. There are a lot of job opportunities. They are looking for people. In fact, this Jackpot season has even opened up a lot of opportunities. A lot of the top firms, big firms you are seeing, a lot of that good people are leaving. Somebody's going to replace them. But there are a lot of spaces, vacancies that cannot
Yeah.
be filled because of there's no the right skill set is not there. So what you want to do is you want to get into the right skill set, get your right skill set, and get into the space where the money is flowing there, and then from there you increase your earning income capacity. So that's what I think you should do about growing your income or
Yes.
your
Thank
economies.
you so much. Just
Welcome.
basically face reality and just look at where the money is in whatever
Exactly.
sector and focus. It's just you have to
Exactly.
face reality. Passion
Yeah,
can
yeah.
come later. Please, this
Pa-
is this is not
Partial
popular
comes
opinion.
later.
This is
Partial
my
comes later. Oh. Partial comes later, please. Okay.
thank you so much. We have so many. So what's your opinion about investing in fintechs like OPay and PamPay? Right? Because I've even had people tell me, don't put so much cash in these fintechs company. That's even if you're just saving,
Mm.
investing with them. So what's your opinion, as someone in this field, what's your opinion about investing in fintechs like OPay, Piggyvest? And
Mm.
please, relating to this question, Piggyvest has some features that does not have an easy exit. Like
Yeah,
there's
yeah,
something
yeah.
called I've forgotten that feature. You can just put your money there, target savings or so, put your money
Mm.
there and
Mhm.
till a specific amount, the time frame you want, and you can access
Yeah.
that money. So they
Mm.
have that kind of feature, but they've proven credible for so long. But
Okay.
yeah, in
Okay.
addition to this question, what's your
All
opinion
right.
about investing?
So for fintechs like OPay and PalmPay, right? Look, I think there's one thing you need to know about investment is that it comes with risk. There
Risks.
is some
Yeah.
level of risk for every investment you take. The only investment that is risk free is when you invest in government securities like government bonds or
Treasury
three
bonds.
TBs, because you know that Nigerian government cannot fail. They can just print money and give you back your money back, right? But for any other kind of investment, if you invest in the company shares, the company can fold up. If you invest in anything, right? So you just have to be for every level of return you expect, there's some level of risk that you are taking. That's the first basic principle of investment, right? Then next is for invest fintechs like OPay and PAMPay that have savings feature, right? You want to save, you want to save. So some of them, most of these investments, most of these companies have what we call microfinance banking license that enables them to accept deposits and do all that. And there is some level of insurance that they get if you deposit your money with them, and if you deposit your money with them and let's say something happens, I don't know, may not be there, something happens and then you can't access your money again. If it's a deposit, you can get you're insured up to the tune of about 500,000 naira from the Nigeria Deposit Insurance Corporation. You will get your deposit back. But where it's a case of, say, you invest in their mutual funds or something, you have to just be careful. So what you want to check, are they registered with the SEC? So we want to
Mm,
check any company that's offering investment, are they registered with the SEC? Are they approved investment companies, investment management companies? And if you think these guys have sound, if you do your due diligence and you think these guys have sound value, all right. And then another thing you want to do is you want to ask, what are they using the money for, right? For most of these companies, what they do is they on lend. So they take your money and they lend it essentially to people, and then they make money from that. So you want to check what their lending rate is. You want to check if the rates they're offering you is sustainable. You want to check if they are licensed. Very, very important. So if they are licensed and they are operating well, and so far you can take the risk and invest in them, but you have to be careful. There's an amount that you can. There's always this principle of diversification, right? So since you have OPay, you have PAMPay, you have Piggyverse, you can, I don't know, you can spread your investment so that you have you have like a safe haven in case anything happens. But I think that's one thing that you can do to invest in those companies. Just
okay,
do your due
thank you.
diligence. But there are a lot of
Yeah, thank
fintechs
you.
out there that are not registered, so please do your due diligence.
Yeah, I was coming to that. What are these licensing bodies? We have a question on display, but before we move to that, like these licensing bodies, you can probably for check from Farm Power. So like these names, you mentioned something SEC. I don't know if you
Yeah,
can
yes, Security
iterate.
and Exchange Commission. So
Okay.
SCC, Security and Exchange Commission, NDIC, CBN should license. There are some banks that take banking licenses from CBN. So the regulatory authorities essentially, once they are registered and they are licensed, then it's good. But once they are not registered or they are not licensed, then you know that you are taking excessive risk, right? That you can avoid.
Okay. Great. So basically, do research, proper research. Take your if you
Exactly.
value
Do
your
your
money,
do your
research. Yes, I research. If you value your money, research in any investment you are about to make. Check if they are licensed, as Mr. Charles has rightly pointed out for us. Thank you so much. We'll take one more, and it says,
okay.
"What is an appropriate exit strategy? Do you
Mm,
need to draw a contract or something?" So that's
mm.
a question from one of the
Okay.
listeners.
All right. So for exit strategy, yeah, I think it depends on the investment, right? It
Okay.
really depends on the investment. So if you're investing in, and you also want to know what is your own investment horizon. Your investment horizon is, how long do I want to invest for, right? So if you want to invest for a period of 6 months, right, there's no need for you going to invest in things that will lock down your money for 1 year, right? They already told you that it's 1 year. So things like let's say savings deposits, that you can save your money and you can, for a particular period of time, say 6 months, that one, you know that, okay, I'm saving another 6 months, I will get my money back, right? But where the things like where you are investing, let's say somebody comes to meet you and say, there's this business that wants to do, and let's invest, we want to use the money to do business, like company that wants to raise fund. If a company wants to raise fund, like a startup wants to raise fund and you want to invest in it, you know that the startup is not going to turn around in the next 6 months. So it's going to be for a long term, right? Now, if in that case, what you can then do is don't give equity, like don't invest as a shareholder. You can lend the money. Lending is a one strategy that investors, I've seen investors use. I say, okay, look, you're a startup, you need money. I won't give you equity, but I will give you loan for a particular period of time, and then you can pay me back. And then you can draw a contract. I think contract is also good. Draw a contract that, okay, yes, you pay me back. But even before you agree to draw a contract and all that, you'll be able to see that at least this company is making money before you learn. Because if they are not making money yet, what are they going to use to pay you? They can only agree on paper. When you take them to court, I will pay, I will pay. That's what the court will, and that's what they can do, right? Then another thing you can also do for exit strategy is focus more on especially if you're buying shares of a company, focus more on shares that are listed on Nigeria Stock Exchange, shares that are publicly traded. So those shares you can easily buy and you can easily exit, right? So focus more on those. So liquidity, that's what we call liquidity of an investment. Liquidity talks about the ease of converting your asset to cash. So you want to make sure you invest in liquid assets. And it will take me to that your piggy vest analogy. There is this piggy vest. What's it called? I think it's a real estate, one of those investment opportunities that they have. One of those real
Yeah.
estate. What they now did now is they now create something like a market where if you want to sell off, you buy from other people. Usually before when you invest, you have to wait till the end of
Yeah.
your investment period
Security
before you
base.
get your money. But now I think they've created a feature where you can sell before time, especially if you have other people that wants to buy. But most times, if you want to sell early on, you be able, you might sell at a loss. You might sell at a value that is lower than that you invest in because of the short period of time. So it depends. You just want to invest in publicly traded securities that you can easily sell off. Lend out money for the particular period of time instead of investing in equity. Then if you are investing in those things like OPay and all that that gives savings opportunity, I think that there are flexible savings options where you can choose the rate that aligns with your investment horizon. So those are some of the exit opportunity that you can use.
Thank you so much. You can see comments, you can see a lot of appreciation.
Yes,
Thank
yeah,
you so
thank you
much.
all.
So a last one before we go, we kind of behind time maybe because obviously it shows that we've been having an amazing section. So
Yeah,
remember you
yeah,
said there's a gap, grow the gap, right? And create a
yeah,
gap and then grow the gap. So for an
yeah.
early investor, someone will say, like you started with MMM. Someone might say, we don't have enough funds to invest in something like you rightly mentioned, enough capital that you can
Mm-hmm,
invest in large quantity that will yield. And
mm-hmm,
somebody wants to know like, how do I now like grow this gap and even now
mm-hmm.
feed the gap? I want to now invest in short term mini investment that has this like MMM
You get
and
your
all of
fingers
that. So
burnt.
how
Okay, continue.
so so now that this person is saying this, because it can be quite tempting. People
Mm-hmm,
want to generate wealth,
mm-hmm,
people want to grow well, but then the income they are having is small. So they want to quickly, grow this thing and then not invest properly. So
yeah.
what do you have to say about that? Are you saying that,
Yes.
oh, like, you're quite unfortunate to be joining I didn't do those things though, Sha, but then some people might be saying, I joined at the beginning, oh, I really
Uh,
in quotes cashed out from this. I've heard people
you
say
get
I
your
didn't
fingers
wait.
burnt soon. You get your fingers burnt. So
Yeah,
look, yeah, there's always that dilemma, right? There's always that dilemma. That's look,
yeah,
I'm not earning enough, but I want to invest.
yeah.
You have to be patient. What it therefore means is that
Patience.
what you should be investing in is not, it's not assets, it's not things like shares, it's not things like land. You should be investing in yourself so that your earning capacity should increase. You want to invest in yourself, take the course, go and buy courses on Udemy, buy that would increase, take that certification, right? That new certification that will increase, go for the masters, invest, save, and then invest in yourself to increase your earning capacity.
Wow.
That is the highest return that you can give to yourself. It's not, I mean, you can literally be earning 70,000 at one point, and after some time, with the right skill and the right knowledge, your next job you can be earning 500,000. And there is no amount of investment that can give you that leap within that short period of time. And this can happen within a year. You can start, okay, look, I'm going to take this 3 months course. I'm going to brush myself up. I'm
Yeah.
going to do this. And then I'm going to start applying. I'm going to start applying. I'm going to start applying. And before you know, you get a good job that would increase your earning capacity. And once your earning capacity is increased, that is when you now say, oh, okay, that gap is increasing, because you want to focus on growing the gap first before investing the gap, right? So there needs to be a gap to invest in. So the quick way, or the easy way out is to say, okay, let me quickly put my, I don't know, 20,000, 50,000 into something that will give me 300%. But you are another reason why that is not even good is you are building a habit that you are doing it
Mm.
with small investment now. By the time you start earning in millions, you will still want to gamble with those big money because you've built the habits already. So it's not just the getting it right. Oh, I joined early. Yes, you joined early. You started with 50K and then you got 150. It's good because you won. The person that lost will never do that thing again. But because you won, you have the temptation to want to do it again. So by the time you are not earning big money, next time what you go and put is 1 million. And then that is when your finger will get burnt. As you get, so it's good you learn your lesson early and don't try to be wise and smart. If something is not good and it's not sustainable, just avoid it altogether. If you don't want to eat the food, don't smell it. Don't bother to taste it.
Ah,
So if it's not good, it's
thank you.
not
I wish I could
good.
scream a thank you right now.
All right, thank you. That's fine. Do we still have any
Can you
more
hear me, Mr.
questions?
Charles?
Yes, loud and clear. I can hear you. Yeah, I can hear you. Can you hear me? Can you hear me? I can hear you.
Okay, yeah. Thank you so much. Thank you. A big thank you. I personally have gained a lot, and I really want to say, oh, happy birthday, Mr. Charles, from
Ah,
YouLead International, from
uh,
YouLead Port Harcourt community. We
thank
are wishing
you.
you a fruitful and a glorious birthday. It's a blessed year for you. Thank you so much for incredible insight. And
Thank
let
you.
me summarize this in case you didn't join us from the beginning. For your own good, go and start this video from the beginning. You know, the
Yeah,
greatest investments you can give, that you can invest in and have the highest return, is investing in yourself. That's
yeah,
number one. Secondly, if you're investing as a beginner, do proper research. Take your time, check if they are registered with the appropriate bodies, if they are licensed. If
yeah,
you are starting early, before you play with the big whales, play with the smaller ones. Start with publicly available
yeah.
trading opportunities that are available. Oh my
Thank
God, Mr. Charles, you graduated.
Ah,
Ah,
why?
MSc student, please,
Why are we?
sir, with a distinction. If you listen to his profile, he was also a first class graduate from University of Benin, and now MSc too. Wow, incredible! It's
Thank you
obviously
very much.
your awards. They match the wisdom and the insights you'll be given. I would not have been surprised. I would
Thank
not have
you.
even expected less, because the distinction really is distincting. It's giving. Thank
Thank
you
you
so
very
much.
much.
Really,
Yeah,
it's powerful.
thank you very much.
Congratulations. Happy birthday. Big
Thank you.
congratulations. And we
Thank
are
you.
so grateful for the value you've given us. And we are praying that bigger doors open for you,
Thank
better
you.
opportunities for you. And I'm
Thank you.
really happy for your growth, because I mean, we go way back, but then this is amazing.
Yeah.
Thank you so much. It
I,
has been
yeah. I think
amazing.
there's someone
Thank
in
you.
the Yeah, I think someone asked for the slides. How do you get it across? I can share it with you,
Yeah,
then
so
you
you
can.
can share it across to Favor. We'll get it
Okay.
across to the
Okay.
platforms that we
All right.
can. And thank you, people, for joining in. If you're on YouTube, you can, your left corner, there's like a three link dots you can click on to watch previous episodes. If you're joining us for the first time, you can imagine the past four series we've had. They are always very insightful and of high value. So do well to, check on the previous series that we've had. And I promise, is a promise from me, that you have something of value and you will gain something. Thank you
Thank you.
again, Mr.
Thank
Charles.
you.
It was
Thank you
really
very much.
amazing having you on this call. Thank
Great.
you, guys. Thank you, everyone. So now we draw the curtain. Thank you so much. This event is brought to you by Port Harcourt community of YouLead International. Bye.